E12-9 says New Vision Company completed its income statement and balance sheet for 2013 and provided the following information. The first requirement says present the operating activity section on the statement of cash flows for New Vision Company using the indirect method. Again, I've written out the formula here for us to kind of speed things along, but when we use the indirect method, we start with net income, we add back depreciation expense, and then adjust for changes in current assets and changes in current liabilities. So I've listed out the items that are out here that actually affect that. They give us an income statement. That's the first set of data that they give us, and then they give us selected changes in line items for the balance sheet. So if we look at net income starts with 9,000, and then they give us depreciation expense of 7.3, okay? Then we have to go down and look at which line items actually affect the operating section. The first one says decrease in accounts receivable. Yes, decrease in accounts receivable will affect the operating section. We do the opposite effect here. So we'll add 12, right? Because that was the decrease in accounts receivable. Next is bought a small service machine. Well, buying a machine or buying equipment, that's going to be an investing activity, so we can skip over that. Increase in salaries payable. An increase in salaries payable, that's a current liability, so we would go the same direction. We add that increase in salaries payable. And the next is a decrease in other accrued liabilities. Well, that again is a current asset, or excuse me, a current liability. And so we go the same direction here. We subtract out the 4.25. This should be all the data that they give us, leaving us with an operating section change in cash of 33.05. Okay? All right. So this is a simple example again for the operating section. Really, the investing and financing section, it's the same way no matter what. So the real focus is if you can remember the operating section and how you do that. The investing and financing section, it should be pretty self-explanatory. When you read through, if you bought equipment, or if you bought something, that's going to be an outflow. If you sold something, that's going to be an inflow. Okay. The second requirement for this problem, it asks us of the potential causes for the differences between cash flow from operations and net income, which are most important to financial analysts. There's varied items that financial analysts would look at, things like capital management, things like improper revenue recognition. The thing to remember is that overall, net income and cash flow, they should move in the same direction given enough time. It's not always the case, but like in certain set years that you look at, but over time that should be the direction that they flow in. If you see a big change in net income, you might wonder why. Is it improper revenue recognition relating to fraud? Or have they changed their revenue recognition methods, their principles that they use, right? Because remember that net income, it's an estimate number in a range of allowable estimates, right? Because there's different methods and different principles that are accepted by GAAP that we can use, and a company can change those if they have a good reason. But the thing about cash is cash is a definitive number. You only have a set amount of cash and you can count it. Whereas net income, you come to this number by instilling certain principles and certain rules, okay? So check for those changes. If you see a large fluctuation in net income in 1 year and it doesn't correlate with what cash is doing, especially over a given span of years, right, then you want to investigate why is that happening, okay? If you have any questions over E12-9, please feel free to let me know.